Hey, welcome back. In this video, we are going to discuss the topics of actually entering and exiting a position. You will get to see these tactics being applied in real time when I start recording trading, live trading data, live trading sessions. But for now, we can discuss them, right? The general idea of exiting and entering a position is that you do not have to necessarily go in and out in one bullet, right? Let me write this out. Scaling in and out. As I was saying, you do not have to necessarily buy everything all in once and sell everything all at once, right? Assuming you want a position of 500 shares of Apple, let's say, right? You don't have to put in 500 shares and then sell 500 shares, right? So the idea of scaling in and out is to basically incrementally get into a position and incrementally get out of a position. And this allows for more flexibility, not just with the actual trade, but also psychologically, as I'll show you, right? And so the concept of scaling in is that assuming a trend following strategy where you are, buying the dip, buying low, selling high, right? Let's say you want to buy this dip, right? Zooming in, right? Zoom in, this is what that looks like, right? The price is coming down and you want to, let's say, buy at a price of $100, right? A clean number. You don't have to buy all 500 shares at $100. What you can do and what traders do, including myself, is that I begin to scale into the position before the price even hits $100. So what I'll do is I will put, a 100 share order at, let's say, 110, right? And I'll put another 100 shares at 105, right? And I'll put 100 shares here, and I'll also put 100 shares at $95, right? And finally, I will put a 100 share buy order at $90. So if you average out these positions, it comes out to a position of 500 shares at $100. But the reason why I want to start entering the position with partial size at $110 is because the price may not come down to $100, right? What if, your price, you want to enter the stock at $100, but the stock never even reaches it, right? Let's say it bottoms at like 102 and starts reversing, right? The actual bottom is 102, right? If you put a 500 buy order at $100, you don't even get to enter the position, right? So scaling in allows you to at least get partial positions in, even if the stock ultimately does not reach your ideal target price, right? In this case, if I have a buy order at $110 and $105, at least I will get a position of 107.5, right? A 200 share position at 107.5, right? Assuming I have two orders, I have these orders and two of them hit, right? And so what this allows you to do is previously where if you just try to go all in at $100, you're not even in the position, right? Now you have a partial position of 200 shares out of 500 at 107.5, right? And let's say, the stock goes up according to your plan, right? And then it comes back down. Now, the kind of interesting thing you can do is now that the stock has confirmed this upward trend, you could add on the subsequent dip the remaining size of your position, right? Because you're in at 107, this allows you more room to add at a higher price. Because what we always want to do is approach the trade from a risk first perspective, right? Let's say you want to enter the stock at $100, right? If the price goes down to $90, you have to stop out here, right? At $90. Because we always want to be able to cut our losses when the investment thesis does not go in our favor. And if the stock reaches $90, which is the price of this lower previous low, then it means that this trend is broken, right? And we want to get out of this position, hypothetically following this example trend following strategy. Now, risk is dynamic, right? Once this trend, let's say you got in at like 107.5 in this example, once this trend proves itself with this new kind of high and then it comes back down, now that the trend has proven itself, you can shift your risk upwards, right? Your previous stop loss was $90, right? Now that the higher high has been established, you can shift your risk higher. If the stock is here now, right? If this stock comes back down again to $100, you can exit the stock at $100 for a loss, right? But now that you can shift your risk higher, this allows you to add at a higher position, right? You are already in at 107.5. You can add the remaining shares at. You can try to add the remaining shares. Let's say this is like at 110, right? Using the same principle of scaling in. Maybe you want to add 100 shares at 115, right? 100 shares here at 110 and 100 shares at 105, right? The point is, at going in and out in increments allows you more flexibility to add, adjust, right? Similar kind of concept with taking profits. So I always take profits in increments, right? I remember I first explained this to one of my friends and he was kind of like mind blown by this idea, right? It's like, it seems so simple, but like not a lot of people actually implement it, right? You don't have to sell all 500 shares. If your profit target is like 120, you don't have to sell all 500, right? All 500 shares. Like you don't have to do that. What you can do is slowly start taking profits, sell 100 shares at 115, right? Maybe you sell 250 shares, right? At 120, right? 120. Maybe you sell an additional kind of 150 shares at 125, right? The point is, even though your profit target is 120, you can start selling earlier in smaller increments. And what that does also at the end of the day, if you execute these three orders, let's say this is 150 shares, right? 150 shares at 115, right? 250 shares at 120 and 150 shares at 125. The average cost basis of your exit, if all three trades executed, is 120. So you're exiting at 120, but you don't have to do it all at the same time. The reason why is this goes back to a psychological kind of nuance, right? Booking profits is always comfortable. So if you just take partial profits at 115, it gives you kind of psychological comfort to be more patient with the remaining position, right? Because psychologically, you're like, oh, I'm already profitable, so it allows me to, be more patient and let the trade work out because it might, go above 120, right? Imagine, booking some profits at 115, right? Imagine if you didn't book profits at 115 and the stock turned against you, right? It's like your your profit target is 120, right? You want to sell 100. Imagine if it reaches $117 and it just comes back down. It happens all the time. So if you did not take profits at 115, it's kind of this situation is you start to get uncomfortable, right? Because you start to get antsy, and then this might kind of ruin you psychologically to the point where you sell on this kind of dip, right? You sell here because you start kind of getting panicky in that you kind of miss the opportunity to exit, right? This is like your planned exit, right? If you don't take partial profits here, you might end up selling at like 110. Sell at 110 in panic because you like out of like fear of missing, you fear that you missed your exit, right? But what happens if you already took partial profits at 115, right? Let's say you took profits on 1/3 position at 115. Now that you are in kind of already in the green, right? You already kind of have some money in the bank, right? Because you cashed out a little bit. Now that you see this dip at 110, you can re-add 1/3 position at 110 in anticipation of the stock going higher, right? But see, the stock, regardless of whether you took profits or you didn't, the stock price is actually inherently neutral, right? It just continues on this trend. But the psychological kind of the psyche, the change in your psychology that results from taking profits changes kind of your outlook on the actual stock price, right? In the first example, you didn't take some profits at 117. Now you're feeling kind of antsy, and then you end up selling in panic at 110, right? Whereas in the second example, you booked profits at partial profits at 117, or sorry, at 115. The stock kind of dipped back down a little bit to 110, and now you can re-add the position that you took profits on back into the stock, buy more at 110 because you sold some at previously at 115, right? And then in anticipation of the next leg up, right? So there's kind of all these kind of complex kind of nuance, psychological nuances when it comes to managing your position, right? Especially when you have kind of larger positions in play. It's booking couple $1,000 here and there. Definitely helps you kind of stay in the trade longer and gives you more psychological comfort in allowing the trade to come to completion, right? And so sometimes, however, this is just an example when the price, you have the kind of luxury of waiting the price. We're zooming in here, right? To basically come to you, right? You set orders out, all these orders out at like 105, 100, 95, etc., right? And you're waiting for the stock to come back down. Sometimes you don't have the luxury to basically wait, right? Assuming a intraday news release where some positive news comes out, right? The stock is not going to come down. It's just going to instantly go up. And in this case, you just have to, go all in, right? If your plan is to buy 500 shares, you might have to, just buy 500 shares at $100 because sometimes, the stock just doesn't come back down, right? And so but to keep in mind is that you want to keep in your trading repertoire this concept of scaling into your position. Because sometimes I scale in, sometimes I don't. It depends on the trade opportunity, but I always scale out. I always book partial profits, right? Quick kind of clarification. The concept of scaling in, zooming in here, right? You have orders at 105, 195 in order to get you an average cost basis of 100. This is not the same as adding to a losing position. What is the difference, right? In this type of analysis, in this type of approach, everything has been pre-planned, right? You pre-planned a total position of 500 shares at an average cost of $100, right? Scaling into your position with a pre-planned entry criteria is not the same as adding to a losing position, which is what kind of amateur and newbie traders do. What is adding to a losing position? You have no predetermined plan. You see a stock going down, right? You start adding at like 105, start adding at 100, right? You keep buying, and you keep adding to a losing position. The difference here is in this approach, keep in mind the idea of a risk first approach, right? In this approach, if the stock, let's say, fell to $90, I'm in at $100. If the stock fell to 90, I would be out of the position. I would cut my loss, right? Because my pre-planned stop loss is $90. Adding to a losing position is different in that you have no plan of when and where to get out, right? You're just adding with the idea of, oh, the price is cheaper, right? It'll always come back up, right? The stock will never go to zero, right? Stocks go to zero all the time, right? So scaling in does not equal adding to a losing position. Scaling in is pre-planned with risk management. Adding to a losing position, no plan, basically, right? With no risk management. In this latter case, if the stock continues, what are you going to do if the stock continues to tank to like $80? Keep adding more, like go to 70, right? At some point, you're going to run out of money to add, right? And at that point, you're just hoping the stock will just come back up, right? What if it doesn't come back down? What if it doesn't? What if it continues to go down, right? This is where risk management comes into play. There are many instances of just assets just not ever recovering, right? Out of the 500 stocks in the S&P 500, since its inception, only one stock remains, and I think it's GE, and they're like on the brink of bankruptcy, right? So stocks go bankrupt, stocks go to zero all the time, and that's why you always have to approach it from a risk first perspective, right? Adding to a losing position is a no-no. You never want to do that, right? You never want to do that. You always want to have a plan and a risk management plan.